This John Lothian news video is sponsored by What is the state of pension underfunding in the U.S.?
With a 0.5% change, a typical fund that is 20% underfunded becomes as much as 30% underfunded. And in California, it was a perfect example when they changed their numbers from 7.25% to 6.5%. So that's a big deal in the investment community, and people are very concerned about those assumptions. And even in that differential between 7.25% and 6.5%, if you could make up for it, if you could enhance that yield somehow, be it with options or a different blend of securities, you're going to make a huge impact on the portfolio's long-term health.
What is TJM doing to enhance yield?
We implement an options strategy that is basically a yield enhancement strategy, where we go in and we'll assess a portfolio. We'll look at the various securities that are involved in the portfolio and show them where they can receive yield. In other words, if you can add even 50 to 150 basis points to a portfolio using strategies like what we do is we use options. Again, other people use different blends. But if you can continue to do any form of securities enhancement through things like options, I think it makes a big difference on their portfolios.
What types of safety mechanisms do you suggest for investors in order to avoid drawdowns?
The first thing you need to think about is, are you talking about a drawdown on the securities when the market comes off, or are you talking about a drawdown because the securities have gone up so high that these options have become in the money and therefore they're losing the upside? So when you typically look at a portfolio, what you want to look at is how much of the downside am I going to participate in and how much of the upside am I going to capture? And if you can get a ratio that balances between protecting your downside risk and mitigating that risk, lowering your standard deviation, and capturing the majority of the upside, then option strategies in general work very, very well. About the only scenario where it doesn't work well is if the market continues to rally on a nonstop basis through extreme levels where people have joked in the marketplace and said we're having a melt up. And in that particular case, you actually end up only being a small drag on the portfolio where you underperformed in an up market, but you're clearly always going to outperform in a down market. And it's that type of protection and yield enhancement that we look at and the ratios that we look at to try to help people balance and lower their standard deviation.
Do you recommend internally or externally managing option strategies?
A lot of that depends on the size of the fund. You know, typically any fund that's over $1 billion+, they're typically going to either think about hiring from within or hiring from the outside and hiring them internally to help manage the risk of the portfolio using options. But many funds out there, they lack the resources, they lack the knowledge, they lack the understanding, they lack the desire to want to pursue that in and of itself because it's such a specialty item using options. So typically what happens is you almost act as the educator and you act as the consultant role in terms of helping them manage the risk of the options on the portfolio.
How effective is such a system in a low volatility environment where options premiums are ultra low?
I don't know if I necessarily would say just because volatility is low in general that I wouldn't sell options against it. It's a case-by-case basis, and so typically if we have 100 options that we're looking, 100 names, and we're looking at those options, we might make 80 recommendations for argument's sake. But maybe in a lower volatility environment, we only see 60 names that make sense, right? And conversely, in a higher volatility market, maybe it makes sense on 90 of the names. So that's part of the model. Over the long haul, it's kind of proven out that if you consistently play the game, if you're consistently involved and consistently have some form of a hedge on where you're going to mitigate some of the downside risk and participate in the majority of the upside, you're going to win over time.